here. I'll give you a brief overview of what Northmark does, and I'll kind of get into what I'm seeing in the market. And then if there's any questions and what have you, then we can certainly go over some of those. Northmark is a national mortgage banking firm. We've got some 35 offices or so across the country. We finance anywhere from $1 million on up. Most of it's non-recourse. Typically on the multifamily side, it's through your agencies and life company, depending upon the size of the deal. We do have some other portfolio lenders that we work with, both here locally, and I'm in Charlotte and cover a lot of the Carolinas and Southeast. But I follow wherever the investor wants to go. So we've done some deals out of our office in Texas, looking at some stuff in Florida currently, and Southeast in Carolinas. I would tell you right now, it's kind of split up between two functions or two factions, your small loan balance stuff, and then your conventional or larger loan deals. I tend to see more of the smaller loans coming to fruition in today's environment versus the larger stuff. Not that the larger stuff's not getting done, but just a little bit more dynamics involved in that versus the smaller loan stuff. Rates today have bumped up from about a month ago when they were down in the 360 range. We're now above 4% on the 10-year. So interest rates have gone up about 50 basis points or so. That's having an effect on some of the deals. On the smaller loan side, you're probably pushing that 6% unless you buy down the rate, and that's been a big proponent as well, being to buy down the rate anywhere from 1% to 2% of the loan amount to get you some additional proceeds. That's been a tool that lenders have used to try to increase proceeds given where rates are in the market. And then on the smaller loan side, depending upon how big or small the market is, your rate can be pushed up to 6.25, somewhere around there, and potentially a higher debt service coverage. So a lot of it really depends on what you have, where you have it, how big it is. That's going to determine a lot of what can and can't be done from a financing standpoint. I would say it's a mixture of both refinances today and as well as acquisitions. Some of the refinances are from the where borrowers are coming out of their bridge loan and trying to just get it on the permanent market. That's been, depending upon the deal and how it performed up until that point, that has been tricky in some cases. Sometimes we've got to wait a little bit to get the collections up. And on the larger side, I think it's just there's still somewhat of a disconnect between what the seller wants on a price and what the borrower is willing to pay for it, given where rates are, where financing is in the market. A lot of deals we're looking at still require a lot of equity if you're willing to do that. And if you've got that 1031, maybe that works for you. If you've got to go out and raise it, it's probably not a fit for you. So I would recommend that if you're looking at a deal, get somebody like myself or our firm to kind of give you a sizing and give you an idea where a lender is going to think that debt's going to come in, because that could be helpful for you as you're trying to put together your letter of intent and contract, or even your bid on the deal, or even if it's worth bidding on the deal. So that's kind of a broad overview. Rates today for larger stuff are in the, call it mid fives. Depending upon your loan to value, you could probably squeeze that down a little bit. And again, rates on the smaller stuff are kind of around that 6% range, give or take, depending upon whether it's a large market, small market. If you've got some affordability within the confines of the deal, All that's going to be taken into consideration, as well as the buy down as to where it's all going to end up. I would also say a couple things from a sizing standpoint is a lot of what we're looking at is how much collections you're bringing in, not necessarily what the rent roll showing. So sometimes there's a disconnect there. And I know we've been involved in a couple of deals where the collections weren't where they needed to be for the seller to get that price. So some of those deals have kind of been put on hold until they get to that threshold. But outside of that, I think if the numbers make sense and it's a deal worth pursuing, then you can certainly get the financing to work within reason. But I would tell you it's there's a lot of hit and miss right now in my view as to unless you've got enough equity to make the deal work, there's a still somewhat of a disconnect between what the seller wants to get out of it, and rightfully so, based on what they paid for it several years ago. But that doesn't necessarily mean a new buyer is going to come in and pay what they want, again, unless they've got the 1031 piece that where they've got enough equity or they can go out and raise it. So that's kind of the broad view of what I'm seeing in the market. I would say it's starting around July, August. It's kind of picked up a little bit. And that kind of goes in where everybody thought back in September when the Fed reduced rates. That was kind of already built in, and now you're seeing the market kind of reset itself a little bit in anticipation of that, but or outside of that. But I would still say it's slow, but it's picking up speed a little bit, and it really boils down to what kind of deal you have, what's realistically available to get done, and is the seller willing to sell at a price that makes sense for you, not necessarily what's right for them. But anyway, that's kind of the take I'm seeing in the market, and everybody's different. Every investor is different, and we can certainly get into some specifics if you want to go there. But that's kind of a broad view of what I'm seeing in the market. Hopefully, we'll see some more transactions take place because the first part of the year was really slow. If you got refinances coming up next year in 2025, I would certainly start looking at trying to do something with that, at least getting somebody to size it and see where that's coming in. Whether you're anticipating of selling it or refinancing it, at least you'll have an idea. And then, who knows what's going to happen? We got the election coming up here in a month, less than a month. How is that going to affect the interest rates in the market? I don't know. I would imagine it'd probably be somewhat as to where we are now, but with politics, you never know. And so you got to cross that bridge when you come to it. But I see it being a little bit more robust, although not nearly like it was back in the heyday, couple 2-3 years ago, where interest rates were really low. And I don't necessarily foresee rates, at least next year, getting down to the 3-4% range. I'd be surprised, but again, we'll have to wait and see what takes place. But that's kind of my take on what I'm seeing. I do see deals getting done. But again, a lot of that is to me boils down to the seller side of the equation, and do they have to sell or do they want to sell, or can they go refinance and get the same benefit that they projected the deal to begin with from a return standpoint? And if they can do that, they may hang on to it for a little bit longer as opposed to selling it. But again, a lot of that just deals with what the seller's trying to do with the property in the given market based on what they're getting feedback from a sales standpoint. So that's kind of what I'm seeing in the market today.
Awesome. There are a couple of questions in the chart. One from Amir. So what's your outlook of rate cuts, treasury rates over the next 12 months?
I'm sorry, I had to turn my volume. Say that again, Rama.
There is a question from Amir. What's your
Uh-huh.
outlook of rate cuts and treasury rates over the next 12 months?
Well, I think initially the rate cuts helped because you saw back at the beginning of September when everybody anticipated um, rates were going to be cut. The market kind of already built that in, which is why you saw the interest rates drop from early September. They were in the 4% range down to about middle of September in the 360, 350 range. Well, now it's kind of built back up. And again, I'm just looking at the 10-year. We're around 408 today. So I think the market's kind of already built the rate cut into it. Now, I will say that that has helped if you're looking from a bridge loan standpoint. And while that was the big loan to get the last couple 3 years because you could do everything off pro forma as opposed to historicals. Um, it's not as prevalent today unless there's a material need for it, meaning that you can't qualify that loan either for an agency or a life company or what have you, just because you don't have the occupancy and income to meet that criteria. So you can still look at a bridge loan, and we're looking at a few. I wouldn't say that's the the metric of everybody, but every once in a while you come across a deal that may need a bridge loan at least for a year, maybe 18 months. Um, and where you can go in and put your stamp on it, so to speak, get it up to where it should be, and then refinance out or sell it into the permanent market. Now, having said that, I will say that if you're going to do that, and we used to do these back in even before 2008, but you need to buy it at a price that's going to give you a lot of upside because your rate on the bridge side is going to be much, much higher. I mean, you're looking in depending upon the size of the deal, you're anywhere from 7 to 12%. So it's going to take a lot of mortgage payment to get that deal. So you're going to want to make sure that what you're buying it for, there's a lot of room for improvement on the back end, and that you're not just buying it. You're not buying a problem deal to get the seller off the hook, so to speak. Um, but again, trying to project interest rates out over the next 12 months is difficult. Personally, I think you're going to be kind of in the same position we are now, but you never know what's going to happen from the political and economic standpoint. Um, where are we still looking to be in a recession? Are we not? If we come out of that, I think you'll see rates kind of stay within this, the 10-year stay within this 4%, 3 to 4% range. And hopefully that spurs on some transactions. But again, to me, it depends on what the seller has done with the property and what can they live with to get out of the property. Because ultimately, to me, that's what's going to determine whether or not they sell the deal or not. So that's kind of the short the short answer is nobody wants to hear is it really depends on how well the property you're looking at is performing or has performed, because you certainly don't want to buy into a situation where now it becomes your problem and now the seller's problem, which goes back to my point on, if you're going to buy these things, you got to buy them the way they're performing now, not on any sort of um, pro forma or anticipation. And I can tell you in some of the specifically in some of the deals we've looked at, even over the last 3 weeks, there have been 3 deals where um, our the client we were working with was bidding on the deal, and it ended up being they weren't necessarily close to what the seller was asking for, mainly because the collections weren't where they needed to be in order to get that price based on where the debt is today. So and some of those deals have been put on hold, but, or they'll try to get the collections up or try to figure out something else. But, I would just be really mindful of where your debt sizing and how much equity you have to bring to the table, because that's really going to determine whether or not you can do the deal or not.
Awesome. Thank you. So there one more question from Angie. So what are your thoughts on companies selling within the next few months because loans are becoming due and they cannot refinance? Will we see a lot of coming on the market?
Well, the short answer is I don't know. I mean, I guess it goes back to my statement on what the seller's trying to do with that deal. If the seller bought that deal several years ago, let's say within the last 5 years, and they bought a rate cap, so their interest rate's relatively low given where it would be in today's market. In order for them to sell that deal at the price they want to get the returns they want, maybe more than what somebody's willing to pay. Now, if that coupled with, if they sell it and you've got a buyer that's got a 1031 that needs to place that money, then you can probably transact that. If there's a price with which they'll be willing to come down to make that deal happen, then you may have more potential buyers for that deal. So if you've got a deal coming due next year, or I would say within the next 2 years, I would be trying to figure out where your debt's going to land today, because whether you refinance it or sell it, the debt's going to be pretty close, because interest rates are going to be what interest rates are going to be. The debt's relatively going to be within reason, the same for both a refinance and a sale, if it's sized properly. So you'll have an idea of what you can refinance it for, and you'll have an idea of, if you sell it for X price, how much equity a buyer was going to have to bring into the table to make the deal work. And so if you can find a buyer that's got the equity that matches what you're trying to do, then maybe you can put a deal together. If you don't, then you may want to refinance it, hang on to it, and maybe you do instead of doing another 10-year deal, or instead of doing a 10-year deal, you do a shorter term deal if you don't want to hold on to it long term. So again, it really boils down to what the seller is, what their goal is on the property. But I would certainly look at it both ways, and we've been doing that for clients here recently that thought about selling them, and we size it for them, and while they haven't taken the sale off the table, they may be leaning more towards a refinance as opposed to a sale. So yeah, again, it just, a lot of it is, to me, involves where the seller is on the deal and the transaction. If they've got a floating rate deal, I would certainly look at putting that on a fixed rate deal. But more importantly, when they had the floating rate deal, how did the property performed within the bridge period? And how can that be helpful to, say, a buyer going forward? Because if it didn't perform during the bridge transaction, meaning you didn't get the rents that you needed, you didn't get the income generated, you're going to be hard pressed to sell it for top of the line in today's environment, because the numbers aren't going to work. And we've seen that in deals we've looked at where sellers are trying to get much more than where the debt's coming in on a sale. And guys are just saying, well, I'm not going to put 50% into the deal or 45% into the deal to make this deal work. But just because the seller wants the price he wants. And it's just not that's where the disconnect is. So again, I go back to how did the property perform when the seller or current owner had the deal, and where are the collections now relatable to what you can get on a current fixed rate deal? And that's going to determine whether you can make a transaction work or not. And I'm speaking from the standpoint mostly from the private sector, meaning partnerships and that sort of thing. Institutional guys, yeah, that's a whole different ballgame because they can come in and write checks and all that sort of stuff. But I'm mainly talking about the BC type assets where you've got partnerships, um, and private individuals involved in the deal. That's mainly what I concentrate on.
Awesome. And thank you again, Kevin. So any take on like any rate cuts next 3 months this year? How much?
How much what now?
How much rate cuts we can expect next 3 months, this year?
Well, if you'd asked me that about a month ago, I was hearing 3 rate cuts. So the one they had in September, and then 2 more rate cuts is what I was hearing. That being said, I think a lot of that is going to depend on, at least if you believe certain economists, that it's going to be based on what the jobs numbers look like. If you see the unemployment rate continue to move higher, I think you're going to see more rate cuts.
Yeah.
If you don't, then I think it'll be it kind of stay the same. Now, having said that, we also heard that because everybody was anticipating a 25 basis point cut and they did a 50 basis point cut. So does that mean now that they'll do only one more cut as opposed to doing 3 25 basis points cut? I don't know. I would tell you, depending upon who you talk with, yeah, there's probably 1 or 2 more coming before the end of the year. But again, a lot of that's going to be based on what the jobs numbers and unemployment rate looks like, in my view.
Yeah.
And that's, it's not really my view. It's based on our internal economist who comes on every quarter and talks about what he's seeing in the market, as well as other economists I trust that I've listened to over the last several years. They're all kind of saying the same thing: is watch the jobs numbers. If you got a lot of jobs and the unemployment rate's low, I don't think you're going to see much rate cuts. If the jobs numbers are lower and unemployment starts going higher, I think you'll see more rate cuts.
Yeah.
Now I think there's other influences in that, but what I'm trying to get across is, to me, that was their main sticking point as to why you might see something like that.
Yeah, absolutely. And that's a great point. Yeah, that makes sense also. Yeah. Thank you. Yeah.
But again, it's certainly active. I think more folks are trying to figure out how to make a deal work or what have you. But again, a lot of it is to me still based on where the seller is on the deal and what they got done with the property when they had it. But because and I would also say that tends to lead more to the smaller loan side, which is 7.5 million and below. I think you see a lot more of those transacting now than you do the larger stuff. Mainly for that, unless it's a refinance, taking the refinance part out of it. Unless if it's an acquisition, to me, it's harder on the larger side just because of what they bought it for. And unless you've got a lot of equity behind the deal or you've got a 1031, it's going to be hard pressed to make that deal work and make your numbers work from a return perspective.
Yeah. Sure. Yeah. Thank you. Thank you again. So I didn't see any other questions at this point.
Okay.
So yeah, and thank you again. That's a very great session.
Yeah, enjoyed it.
Yeah, some very good questions. Yeah. I think they need your contact info. So maybe you can put in the chart or something.
Yeah, I can get that over to you.
Yeah.
And then
Yeah,
you can ship it out to everybody.
yeah, you can put your contact in the chart. So,
Okay.
so yeah, feel free to reach out, Kevin. He's from Charlotte, North Mark. So he will help you with, financing side.
Yeah. And again, we look at deals all over the country. But I would tell you primarily because where I sit in Charlotte, most of the stuff I'm doing is the Carolinas and Southeast. But and we've got 3 deals we're eyeing in Ohio, a couple deals in Texas, a couple in Florida, couple in Georgia. So it just I follow wherever the investor wants to go.